And the uncertainty around the war in Iran continues to impact markets and oil prices. My next guest believes the current oil shock could put global economies under severe risk. Let's take a closer look with Martin Pelletier, Senior Portfolio Manager at TriVest Wealth Counsel. Martin, thanks very much for joining us.
You betcha. Thanks for having me.
I mean, I think just looking at the markets today, everybody is kind of flipping coins, it feels like right now, trying to figure out where to go.
Yeah, there's going to be a lot of uncertainty until we get some sort of clarity at what's happening in the Middle East. This higher oil price, it's important to make a distinction between a supply shock versus a demand-driven rally, and understanding how that triggers and works its way into the market, and how that impacts risk assets and non-risk assets. And once you get your head around that, it really tells you a lot about the positioning and how we're seeing these moves happen on a daily basis.
I mean, we're seeing oil again today. The fear is back that the war may escalate, and oil's not jumping, but still 3% today.
Yeah, so we're in a supply-driven shock. And during these episodes, typically oil and the U.S. dollar rallies together. And when you see a demand-driven oil rally, you see oil rally and U.S. dollar fall. And we're not in that scenario. And as a result, it creates a dislocation, and people don't want to be buying long duration assets. So, for example, longer term bonds have done poorly. Longer duration stocks like tech stocks have done poorly. And even gold has sold off on the U.S. dollar rally here. I think the catalyst was last week's Fed FOMC. And they certainly didn't act appropriately, in my opinion, given the demand impact this is going to have. That could send the U.S. into a recession, or certainly move it towards stagflation. And other central banks are going to have to take cue from that.
Would you like to have seen them be a little more dovish then?
Yeah, they absolutely should have. If you take a look at the previous supply shocks, 1990 Gulf War, the Federal Reserve actually eased their policy during that energy spike because growth was weakening. Also in 2007, they did the same thing. If you look where we are today and you do the impact of current oil prices on consumers, especially in the U.S. and gasoline prices, working with my good friends down south, Gas Buddy, $300 to $350 million a day is the economic impact on the working class in the U.S. And that's equivalent to a 50 basis point rate hike. And so if you look at the FOMC minutes last week on the dot plots, they became a little bit more hawkish when they should have been dovish. And I mean, the Fed and central banks tend to be reactionary instead of proactive. And that you can see any sort of risk assets sold off hard on that FOMC, including gold sold off, which isn't a risk asset. It's perceived to be a safety asset, but that in particular is tied to the U.S. dollar. And then the U.S. dollar went higher. So that FOMC really threw a wrench into the market last week.
All right, I want to get to some of your picks, but I want to ask first about, you mentioned about stagflation, possible global recession. How close do you feel we are right now? Do we still have some wiggle room?
We do have some room, but if we're still facing the same kind of situation we are in 30 days from now, it's not going to be pretty. And central banks are going to have to be proactive here. You look at a lot of major feedstocks, fertilizer, sulfur. This isn't just oil, and how that's triggering in rising commodity prices in certain segments of the commodity market, and economies that are weakening or fragile. At the same time, you have governments running big fiscal deficits and don't have a lot of dry powder. And central banks are going to have to start printing to substantiate this and try to stimulate growth. So yes, if and I think oil stocks are telling you that, and other segments that are tied to the potential benefits of higher commodities are saying, looking longer term, the demand weakness is going to be quite pronounced. So we have to get this under control in the Middle East, or some sort of visibility towards an off-ramp for the U.S., but it's looking like it's more of an on-ramp for Saudi and UAE and others coming into the conflict.
Okay, well, let's get to some stocks you're looking at, maybe take advantage of the situation. AEM and BHP, we'll kind of put those two together.
Yeah, and I've been on your show and I've recommended them. AEM's off 20 to 30% from its highs. And so it's a levered way of playing gold, although it has a super clean balance sheet and cash in the books, but and generating a significant amount of cash flow. It is a levered way of playing gold, and gold's off almost 20% from its highs. And the reason being, again, is the Fed and the higher dollar and a hawkish outlook is not good for gold as a commodity. In addition to countries being worried about selling off or raising some capital, and gold has done well for them, so they've been selling some gold as well. Potentially, there's no verification of that, but that does make some sense. So I think when eventually this conflict does get resolved, and there's tremendous pressure for it to happen, that gold and gold-related producers are going to do very well. Now, if you'd missed out on the rally, here's a second chance. They don't come around very often.
All right, and then BHP?
Yeah, copper's been really hit on the economic outlook. BHP's probably the best, in my opinion, or our opinion here at TriVest, that it's the best copper producer out there. Does have some exposure to the fertilizer space, and it's off 22% from its highs. We think the AI build-out is not under risk unless the feedstock costs continue to escalate and we stay at stagflation environment. And also a big source of funding for those AI build-up comes from the Middle East and from countries in the Middle East. So as soon as we get some stability there, we're going to see a resumption in that AI build-out, and that means a resumption in demand for copper. In the meantime, inventories and supply is going to get impacted by this drop in price. So that'll set up a nice recovery here for BHP. And again, if you missed out on that rally, there's a second chance here, in my opinion.
All right, and those are the ones that you're adding to your positions on, and you're starting to add a position with NTR, with Nutrien.
Yeah, looking at the fertilizer, 2005 was a bumper crop, and farmers are going to need to add nutrients back into the ground. The feedstock costs are tremendous. And nitrogen and sulfur have been impacted by the Strait of Hormuz, and as a result, there's some concerns about how that's going to impact demand. However, longer term, when you're driving a car or a race car, you want to look where you're going, not in over the hood. And if you look where you're going, demand for fertilizers and phosphates, nitrogen, and related are going to go up, and they're going to be quite strong. And those stocks have performed, okay. I mean, they're having a good day today. But we've been adding to Nutrien on each of the dips that have been happening.
All right, we have to wrap it up there. But just one last note: you're holding your oil position as well. Martin, thanks very much for joining us.
You betcha. Take care.
Martin Pelletier is Senior Portfolio Manager at TriVest Wealth Counsel.